Hello, everyone, and thank you so much for joining us today for our webinar, 6 Ways to Originate More Purchase Business. Now, throughout the webinar, as questions arise, as I'm sure they will, please go ahead and use the questions function and type them as they occur to you. At the end of the webinar, we're going to have an extensive Q&A, and we will answer all of your questions. With that, I will turn it over to today's speaker, John Kolitz. Take it away, John.
Well, thank you, Rose, and good afternoon to those of you on the eastern half of the United States, and good morning to our friends on the western United States. My name is John Kolitz. I'm the Regional Sales Manager in the Northeast, and we're joined today by the Director of Underwriting for the Eastern United States, Mr. Tim Turley. Today, we're going to talk a little bit about who is LendSure, what is today's objective, a little bit about marketing, the 6 ways to originate new business, some product review, how to do business with LendSure, and our commitment to you, and then we'll follow that up with some questions and answers. About us, we were founded in 2015. We're headquartered in San Diego, California. We have a regional ops center in Rhode Island and one in Atlanta, Georgia. We've been securitizing loans since 2017. When I tell you we probably have the most highly experienced management team in the non-QM business, I really mean it. We've got probably the best of the best. We're currently lending in 41 states, and that number continues to grow. What do? We are strictly a non-QM lender. We're focused on making loans with solid benefit and performance. People sometimes ask me, well, non-QM, is that subprime? And nothing could be further than the truth from that. Non-QM, if I were to describe non-QM lending, I would say that the difference between us and Fannie, Freddie, FHA, VA is the way that we determine the borrower's ability to repay is different. We do a lot of bank statement and asset depletion loans and a lot of DSCRs, or debt service coverage ratio loans. Our average FICO is north of 700 and our average LTV is less than 70. We don't do Fannie, Freddie, FHA, VA. We don't do bails, and we don't do equity products. What's today's objective? To introduce you to the market opportunities of non-QM lending, to give you some market strategies, to give you some product knowledge, and show you how we can help you grow your business. Do you stand out? You may or not believe this, but you're not the only ones calling on realtors. You all have the same thing. You all have Fannie and Freddie and FHA and VA, and you're all walking into that realtor shop or calling that realtor and telling them that, hey, my rates are better, or my service is better. What makes you different? What is your value add? So give them what they don't have. Become a subject matter expert in non-QM lending, the bank statement and DSCRs, foreign national, asset depletion, and bridge loans. Be the loan originator that will help them find and close more transactions. Refer business to them. Talk about marketing. Things aren't the same as they were pre-COVID. You can't just walk into a realtor shop and say, hi, I've got some donuts here. Can we talk? Now there's so much more email marketing, social media marketing, LinkedIn, Instagram, Facebook, and Twitter. You know, you walk down any street in America and you see people with their face in their phone because they're looking at their emails and their social media and they're texting. You know what? I don't know many people that are using texting for marketing, but I have known a few and they've been very successful. It's amazing. Everybody looks at their text. Direct mail is still alive and well. Webinars and Zoom calls. You know, what a great opportunity to deliver your message face-to-face to a large or small audience. And of course, we always like to do those in-person calls if and when possible. Flyers are always a big thing. You know, if you can't see somebody, always drop something off on their desk if you can. A coworker of mine used to send out Todd Duncan's High Trust Selling or Time Traps, and he'd send it via FedEx or UPS with a little handwritten note to that client that he was trying to get his foot in that door and never could. Funny thing is everybody always opens up that FedEx envelope. They always open up that UPS envelope. It could make a difference in getting your foot in a door that just could not open before. And make sure that your message is audience specific. And of course, there's always a phone follow-up. You know, There's no substitute for direct contact with your potential client. Call them, ask them, did you get my email? Do you have any questions? Can I schedule a presentation? Education is so important. So, the 6 ways to originate more business. One, expand your product line to include non QM. Market to business owners, market to property investors. Tap into that growing foreign national market. Tap into the luxury market and become a bridge loan expert. I'm going to tell you right now, you learn the bridge loan program and you will be getting more business from people you weren't getting business from before. Expand your product line. 5 to 10% of the mortgage market in the next 24 months is going to be non-QM. Believe it or not, that number is $154 billion. I will tell you the rules have changed. Non-QM awareness of non-QM has risen, but adoption is still low. So there's a tremendous upside. There's great opportunity here. Non-QM is here to stay. The rules changed since 2007 when we were doing what we call irresponsible lending, that 80/20 stated wage earner. Well, no, it's different now. We have to, by law, prove that our borrowers have the ability to pay us back. In fact, the securitizers are now required to retain 5% skin in the game. They have to have 5% retained ownerships in those securitizations. So non-QM is here to stay. Education is the key. Educate yourself, educate your referral sources, and make sure that they understand how to educate their borrowers. Know the primary products. Know about bank statements and DSCR products. Those are probably the top 2 products in non-QM lending, probably represent 70% of non-QM lending today. Get with it or get out of the way. Love this slide. This tells us all about the self-employed borrower today. That self-employed borrower, if you talk to the IRS, he's got no money. His pockets are empty. But if you look at his bank statements, he's doing just fine. He's driving to the country club in his new Mercedes-Benz SUV. But again, he's having difficulty qualifying for that Fannie Freddie kind of product or even that jumbo product because he can't prove his income. Market to these people. Today, 44 million Americans, roughly a third of the workforce, is self-employed now. These are not only your borrowers, but they're also your referral sources, the real estate agents, contractors, plumbers, investors, developers, attorneys, doctors, etc. And I will tell you, finding these people, it's not hard. They want to be found. They are self-employed. They are in business, and they want people to find them. So guess what? It's not going to be hard for you to find them and to market to them. Number 1 product for these people is our bank statement programs. Question always comes up, well, how do I figure out how much money that you're going to use for the ability to repay? Well, we will do an upfront evaluation of income for you. You don't have to guess. We will do that for you even before they move forward and look for a property. So send in the bank statements and we'll review them for you. Unlike most of my competitors, I'm not going to ask for a CPA letter or P&Ls. Borrower does not have to own 100% of their business. We will accept multiple business bank accounts. And we have a variable expense ratio, which is on a case by case. Every transaction we look at has its own expense ratio. We will go down as low as 10%. Most of my competition has a minimum of 30. In fact, one of my competitors recently said that if it's going to be under a 50% expense ratio, they have to have a letter from a CPA. Well, good luck getting that because CPAs don't want to write those letters and they certainly don't want to sign them. Give an example. We had one recently that we had that the borrower was a psychologist, and actually one of my competitors had turned it down because they had a 50% expense factor. The guy had $900 in rent. He was a sole employee. Didn't have any other employees. Small rent of $900. Over $10,000 a month in revenues. We looked at it and said, well, why would I give him a 50% expense factor? In reality, 15% works just fine based on his business and his profile. So we closed the loan. NSFs and overdrafts, we're not real crazy about them, but they're not necessarily deal killers. And we do have a 12 and a 24-month bank statement program. Let's talk about marketing to property investors. Property investors usually don't stop with just one property. And as they build their real estate portfolio, it means a steady stream of purchase and refinance business for years to come for you. Our investment property loans, we have no limit on the number of properties that an investor owns. We can finance up to 10 loans ourselves for one investor. We'll go up to 50 DTI. We'll do non-warrantable condos and condotels. We'll do full doc, bank statements, and DSCR. When we determine the ability to repay on investor loans, there's three ways to do that. One is full doc, which is always the lowest rate, more documentation, more complex. Then we have our bank statements, which is a mid-range, 12 to 24 months bank statements. And then the third is our investor cash flow, or DSCR, highest rate of the three, but not real high. The simplest process. The DSCR loan is basically where we're determining the borrower's ability to repay solely on the property's ability to cash flow. We're not even asking you how much the borrower makes elsewhere. We're solely looking at the numbers on the property. On our investor property expanded, which is full doc and bank statements, we'll actually go up to $2 million. And I will tell you, probably 30% of the business that we do at Lenshore is actually an exception to our own rules. We've done loans I've seen up to $2.5 million on investor properties. One of the things that will absolutely increase the buying power for your borrower is that we will qualify them on an interest-only payment. We don't have to go with a fully indexed payment or a fully amortized payment. We'll qualify on that interest-only payment. That will increase their buying power. We'll do purchase money loans up to 80 LTV and cash out to 70. We can even close in an LLC. On our DSCR loan, which is the debt service coverage ratio, as long as the borrower is breaking even on that property, has a 660 FICO, has the reserves, and has a good credit history, we'll give you an 80 LTV on a single family or 75 on a 2 to 4 family on a purchase. We can also do cash out on investor loans, which we're finding that a lot of our borrowers are doing that. They're taking cash out of certain properties that they already own and buying more properties. Have you tapped into the growing foreign national market yet? $78 billion in annual purchase volume in the foreign nationals, 183,000 transactions, of which 8% of those are homes worth more than $1 million. Where do you find these people? Well, you know what? You find international real estate attorneys or tax attorneys. You look for real estate agents that work with Chinese borrowers or buyers. You look for CPAs that work with foreign nationals and immigration lawyers. Look for real estate listings in different languages. You connect with groups such as the National Association of Hispanic Real Estate Professionals, or ARIA, Asian Real Estate Association of America. I will tell you that we're a member of ARIA, and we've seen a lot of loans come through ARIA. Make sure you join that group. On our foreign national programs, we'll go up to 70 LTV on a purchase, refi, or cash out. Credit scores are not required. We accept foreign credit reports or even credit reference letters if credit reports are not available. As long as we have 3 credit reference letters, as long as one of those is from an internationally recognized financial institution, we'll take credit reference letters. We'll also accept income verification letters from a CPA or equivalent in their host country. Foreign assets can be used for reserve requirements, and your experienced AE will help you through this process. Have you tapped into the luxury market? Great opportunity right now. People want to move up, but often they can't because of loan limits or their ability to document their income. Again, understand that bank statement loans can increase the buying power of so many people. There's a great opportunity right now with the exodus from the big cities to the burbs. A lot of people are moving out of New York and Philadelphia, Chicago, etc. They just want to get out of Dodge, or they want to get out of the suburbs. Great opportunity. Take advantage of it. Conforming limits are still a lot lower than that $2-3 million that we can do. Jumbo loans by Lenshore, we do owner-occ, second home, and investment properties. Interest-only payment options are available. We have asset depletion and asset qualifier products. The asset qualifier product, we actually take available assets and divide that by 60 months to come up with the ability to repay. We'll do single-family non-warrantable condos, condotels, and 1 to 4 units. Probably one of the hottest products that we have right now is our bridge financing. For those of you that understand it, it's basically we're taking a loan against the house that they're going to be selling. We're going to take that money and we're going to use that for a down payment on the house that they're going to buy. It enables your borrower to make an offer that's non-contingent on the sale of their current property. We'll go up to 75 LTV on the bridge loan on the departing property. If we're going to do the bridge loan, we have to do the loan on the purchase, and we'll go up to 80 LTV on that purchase. Understand this. There's no monthly payment required on the bridge loan for 12 months. So you're really giving the borrower up to 12 months to sell their current residence. and they don't have to worry about, am I going to have to carry more than one payment? We're also not going to hit them on a payment amount on the bridge loan on the purchase money loan. So we're not going to include any number on that for their DTI. Their departing property has to be listed on the MLS, and the loan amounts can be as high as $3 million. I'll tell you this, I had an interesting transaction that we started about 90 days ago, and we closed it about 45 days ago. Came from a realtor friend of mine who actually lives across the street from me. And the question was, okay, wasn't sure that his borrower wanted to go to the expense of a bridge loan because he didn't want to take on that additional cost. But then he looked into it pretty close, and we talked about it. And we said, okay, well, based on his current residence, and this is exactly how this one worked out. What was the value of his current residence? And it was 500,000. He said, well, listen, if he had to make an offer contingent on the sale, he was probably going to have to sell it quick and would probably get 96%. If he was not forced to sell it too quickly, then he could probably get a little bit more than the current residence value of 500, so he's getting maybe 103%. These numbers were coming from the realtor. We were guessing a liquidation cost of about 7%. He owed 198 on it, and we figured that it was going to be 120 days to sell that property. Then we talked about the purchase. Well, the list price on the one he wanted to buy was 785, but he thought, you know what? If he had to make an offer contingent on the sale of his property, it was more than likely in as crazy a competitive market it is right now that he was probably going to have to pay a premium. Without having that contingency, he didn't have to pay a premium, so he was able to pay the list price. After we looked at all the numbers and we factored in what is the carry cost of the bridge loan, what is the interest cost of the bridge loan, what are the closing costs, etc., and what were the gains on the sale of his current residence and the savings on the purchase of his new residence, the gain to that borrower, even with the cost of the bridge financing, was $41,000, and that was real money in the borrower's pocket. So I would behoove you to learn about bridge financing and learn how to sell it. Our product line includes a super prime product, which is bank statements, asset depletion, and bridge. The super prime is our lowest rates, and this would be our owner occupied products. We have an expanded approval line. We have our investment property loans, which are expanded in DSCR, and our foreign national. On our super prime, we'll go as low as a 680 FICO. We'll go 90 LTV with a 740 FICO. We'll go 85 LTV up to $1.5 million. We can do 12 and 24-month bank statements. Don't do much ARM products right now. Primarily, we're doing fixed and interest-only products. We'll go up to 80 LTV for first-time home buyer. We'll go up to 80 LTV on non-warrantable condos for those of you that have those in your markets. And again, we'll go up to $3 million. One of the neat products that we have is called asset depletion, and I always call this the trust fund baby loan. This is for that borrower who has significant assets but just cannot prove their income or cannot prove enough income. And the way that it works is we're going to take 100% of their cash or equivalents, we'll add 80% of their stocks and bonds, and then we'll add 70% of their retirement assets. We'll total that up and we'll divide that number by 120. That's the number that we're going to use for their income for their ability to repay. On my asset qualifier product, we'll actually divide that number by 60. A little bit more restrictive, and your account executive can certainly tell you more about that. One of the things that we do here at LendSure is we actually do what I would call hybrid income. I recently had a transaction where the borrower lived in Boston, recently retired, and wanted to buy a second home in Florida. Had Social Security income, had a small pension, but that was all of his income, and the income was not sufficient to qualify him for the purchase of the property. He probably could have cashed in a lot of assets to buy the property and pay cash for it, but he didn't want to do that for a number of reasons. So what we did was we took a look at what were his assets. We added all of his assets up. We divided it by 120 with a qualifying asset number. And then we added the asset depletion to his Social Security and his pension. We were able to qualify him for the loan and close his second home in Florida. On our expanded approval products, this is owner-occupied second homes and non-owner occupied. We can go up to 85 LTV with this product, full doc bank statements and asset depletion. We can do non-permanent resident aliens with this product line. We can do ITINs up to $500,000. And this product line has the ability to give loans to those who have had varying levels of credit events, such as 24 months from a bankruptcy discharge or a foreclosure, and as long as they're not any more than 30 days past due in the last 12 months on their current mortgage. One of the really cool things about LendSure is our unique pricing options. We have the ability to finance your compensation on top of the loan to value. What does that mean? It means if I'm doing an 80 LTV loan, I can finance 2% on top of that and go to 82 LTV without changing the pricing for the borrower and increase the loan amount and put your compensation in the loan. Well, what is the benefit of that? Well, it's a lower rate for your borrower. It's a lower payment for your borrower. It's less funds required at the closing table for your borrower, or more cash out for your borrower on a refinance. Your account executive will certainly show you how this solution works to yours and to your borrower's advantage. I'm going to allow Tim Turley to maybe share with you some recently closed transactions that we've done. Tim, you there?
Yeah, John, thanks a lot. So I'm just going to cover a couple of loans that we've closed over the last few months that might be of interest to our audience here. The first one was the house up in the Hamptons, and it was an investment property, and it was a father and son. They had a history of buying investment properties, and they were trying to get the maximum amount they could for this refi. They didn't have traditional income. They couldn't prove it, but they did have a excellent credit. And what we ended up doing for these guys, we put them on a 75% LTV. They had huge assets at $12 million post-closing. And so, as John just mentioned, when he went over the asset depletion program, we were able to use that to qualify them and make sure they met our ATR rules. And I believe that loan closed in, it was either November or December. So it was an excellent loan. The next one, as John just kind of went through the programs we have, this was a 24-month bank statement loan. And it's similar to the scenario he talked about with the expense factor. They had gone to a competitor, and the competitor used across the board a 50% expense factor. Well, this guy was a truck driver. And when we had a conversation with the broker and then ultimately the borrower, we were able to find out that his company that he contracted through actually paid for his gas and insurance. So when we looked at the actual expenses, they were far less than the 50% that the competitors used. We reduced it to 20%. We got him to qualify for a new purchase at 80%, and his debt ratio came out at 38%. So it was another example of how by having an expense factor that is a true expense factor and not just a fixed one, that we were able to get a loan done that our competitors couldn't. So this next one is a traditional W-2 employee, and he worked for a consulting firm, and then he decided to open his own company, but it was in the same line of work. He had 12 months worth of bank statements to show his income, but he hadn't filed his taxes yet for his new business. He did have good reserves. He had 6 months worth of reserves. He had a 770 FICO. We went ahead because it made sense. The guy had a history of working in that field. We were able to look at his prior earnings compared to what the bank statement showed. They were similar, and we went ahead and closed this loan. It was a $720,000 purchase, and we did it 80% LTV.
You know, Tim, this is one of my favorite examples. The only reason I say that is because here we took a borrower that's less than 2 years self-employed, but we did the loan. Who else is doing that? But the thing is, the loan made sense. You know what? It was a loan that had more than enough compensating factors that said, you know what? We like this borrower. We like this loan. We're going to find a way to get it to the closing table.
Absolutely, and we do that every day. I mean, there's a lot of borrowers that just fall outside of that tight box, but it still makes sense to make them a loan because we know they're going to pay. And to John's point earlier, a lot of our loans fall outside that box, actually greater than 50%, I would say. And if none of us get paid if we don't make the loan. So we're constantly looking for ways to make good loans to people that are going to pay us, and they make sense. So here's another example. And I remember this loan well because I was the one that approved it. The guy founded a technology company. He had a great FICO, and he was semi-retired. He was, he got a salary from a local college. He did some professor work. He had Social Security income, and he had 10 different LLCs that he was part of that he got income from, but he also had $2 million that he had put into trust. Um, and when you looked at the loan, it technically didn't fit the box of asset qualifier, asset depletion. But he had the money, he had access to it, and we ended up doing this loan, and it was actually, this says loan size greater than 3 million, but it was actually 2 loans. And we did both loans. We actually got the guy in at a 48.8 using our interest only product, brought him down to a 42.7, and he was ecstatic because he had a balloon payment due and nobody wanted to touch him. It was another great example of thinking outside the box and making a make sense loan.
Well, thank you, Tim. Well, so now the question is, how do you do business with LendSure Mortgage? Well, this is how you do it. The pre-qual process. This is probably one of those things that makes us different than any of our competition. Is our pre-qual process. We understand what the ramifications are of what we tell you. We understand that when we tell you we're going to do the loan, that you're going to turn around, you're going to tell your realtor, you're going to tell your borrower that you're going to be able to do this loan. Well, you need to have a level of confidence in what we tell you. And it's for that reason that every single pre-qual that we do is signed off on by somebody that has the authority to approve it. I cannot tell you how many times we have identified what we call the elephant in the room and have had to go to Tim or even one of our co-founders and say, we really like this loan. However, it's an exception. Can we get by this? And the answer is yes. We go back to you and say, yes, we could do this loan. Now, I can't tell you how many times I've talked to some of my brokers and they've told me, listen, I've had so many loans that our account executive says, yep, we can do that. Here's the program, here's the rate. And then it gets to an underwriter, and then all of a sudden it's a problem. We identify it early and again have it signed off on by somebody that has the authority to approve that loan. Once we give you that pre-qual, then you would go back to your borrower, give them the terms of that pre-qual. Then you would submit all of the things that we've asked for in that pre-qual after you've sold it to the borrower, and you would submit it in our TPO system. We would then disclose the loan because we, as the lender, do all the disclosing. We then go ahead and send you a conditional approval after it's underwritten. We clear the conditions, CD, close, and fund. So 20 minutes to a greater sales in 30 days. So this is really the commitment we're trying to make to you. Our account executive will be contacting you to schedule that 20-minute session. Understand that the support does not stop with today's webinar. So what we're going to do is we're going to show you, after we do a consultation, how we can leverage your current book of business. We're going to discuss trends and opportunities in your market area. We will uncover opportunities for growth. We're going to develop an action plan to help you grow your sales in 30 days. We will train and support your team. We will partner with you in presenting to others. We will provide you with marketing materials, including PowerPoints, flyers, email templates, social media templates. Here's some examples of some of the things that we have in our template library. These are flyers and postcards and templates that basically they're all ready to go, and they're not branded with our information, but they're available for you to brand with your information. Well, we certainly appreciate you taking your time today. We know everybody's certainly busy in this current environment, but we're hoping that we can help you grow your business. And I'd say more importantly, you can help your clients grow their business. Because at the end of the day, if we can help you grow your business and you can help them grow your business, you're going to have a lot more clients that are going to be a lot more loyal. So thank you for your time. Rose, you want to go ahead and open it up for questions?
Absolutely, John. Go ahead, everyone. If you have a question, please go ahead and type it up in the questions tab now. Whether it's about programs, whether it's about anything, just let us know. I've got the most popular question so far, John, is will we get a copy of the slide deck, and is this session being recorded? The answer is yes. I know we covered a ton of information in a brief, and because we respect your time, we wanted to cover it in as brief a time as possible. So it is a ton of information, but don't worry. Look for an email in about an hour that will have a link to watch the webinar, which you can feel free to share, and it's also going to have a link to download the slide deck as well. So with that, let's see. Bank statements. Does it have to be business bank statements, or can you do personal?
I'll take that, John. We
Okay.
actually will allow both. We do both business and personal bank statements on both our 12 and 24-month program. And we can actually use zero expense factor on personal bank statements is if you can provide us a business bank statement that shows that the borrower pays their business expenses through their business account. So the answer to your question is yes, we will do personal, and it can actually so we don't apply expense factor in the event that you can provide us a business bank statement to show that the borrower pays their expenses through another account.
Okay. Do we do lending outside of California?
We're lending in 41
Absolutely.
states right now, so yes, the answer is yes.
Are we limited to 4 units?
Yes, single family 1 to 4, condos, warrantable and non-warrantable.
Can you do loans nationwide? I think we just answered that one. Um, sorry. Can brokers do loan with you business type in Florida? I think is what they're asking. If we lend in Florida.
We do.
Yeah.
Okay. Do you have a rate sheet? We do have rate sheets, and if you respond back to the email that I'm going to send you in about an hour, that's going to go to my email address. So you could just go ahead and just request it, and I'll send it off to you. Okay. Um, can you do it with a client putting 25% down and 800 FICO?
Love those deals.
Okay. Do we do non-warrantable condos?
We do.
Okay. And then, do you provide non-resource loans?
Rose, could you
Not
say
quite
that
sure
again?
what that is.
I'm not sure whether no resource loan is either. So,
They may be referring to a loan with no assets. We do require reserves on all of our products. We do make exceptions to that occasionally. So if a borrower is using all of their down payment or all of their funds for down payment and have no reserves left over, we would have a hard time making that loan. But we do allow gift funds, so there are alternatives.
does the DSCR program require the borrower to have other rentals or have HD rentals? I'm not sure what HD rentals is. What is the reserve requirement on the rental of all the properties?
On
On
our
the DS,
DSCR, we're looking for 6 months reserves.
Okay,
and we do
and
not require them to own other rental properties. We can do a first-time investor as well. First-time investor, we want them to own their primary residence for 12 months, and we max LTV is 75 versus 80, but we will allow a first-time investor.
okay, great. As an investor, do you keep all your own loans? Is that how you can underwrite so far outside the box?
We actually, one of our partners is also an investment bank that we sell the majority of our loans to. And we just have a very good working relationship with them. We have full underwriting authority to do any loan up to $3 million, pretty much. So we don't hold all of our loans, but we securitize the majority of them. And based on, as John mentioned earlier, the performance of our past securities, we continue to get more favorable pricing monthly. I think we do a really good job of making sure that our borrowers are going to pay us versus fitting them into a box. So we're constantly being creative and making sure that when, at least for me, when I sign a loan, I feel very confident the borrower is going to pay me, regardless of what box I fit them into. And I think that's probably one of the things that sets us apart from a lot of other competitors is we are looking to make good loans to people that are going to pay us, not people that fit into a box.
Yeah, I think you're right, Tim. That's a competitive advantage for us. It's almost like because of that relationship with our investment bank that we're more or less direct to market. They're direct to securitization, so we don't have to go to another bank and say, "Will you approve this or will you buy this?" We already have the authority to fund those loans.
Exactly.
What's our compensation look like for brokering to Lenture?
Well, we can go up to 2.5% BPC and up to 2% LPC, and it would really all depend on the LPC agreement for each individual broker.
What's the down payment
I would just
requirement?
add,
Oh, go ahead, please.
Rose, I'm sorry, I'm just going to add one more point there. John mentioned earlier something that I just wanted to throw out there is the broker compensation. We do allow stacking, which is a huge competitive advantage for us in comparison to our competition. So if your borrower qualifies at up to 85% LTV, we'll stack up to 2%, making their LTV 87%. And that 2% can be used for broker compensation or other closing costs. So where somebody else says they're going to approve you at an 80% loan, we give you the same approval at 80. You actually can get an approval at 82, where the other people aren't going to go to 80. So the borrower's going to actually bring more money to closing, whereas us, they may be able to finance that in. And I think that's something that would be very important to this audience when they're looking at maximizing the benefit to their borrower.
What are the down payment requirements for non-warrantable condos and for foreign nationals?
John, I'll take this. For foreign nationals, typically we're looking for, and it also, there's a lot of factors in there: cash out, whether it's a DSCR, whether it's non-warrantable condo. But for foreign nationals, our max LTV is 70. We will go to 75 on a case-by-case basis. On our DSCR program, we'll go all the way to 80%, which would be 20% down, but we have done 85% on a case-by-case basis. Now, those LTVs vary for the DSCR based on credit score and other factors. Are they getting cash out? Is it a rate and term? Is it a non-warrantable condo? Those type of things. But we can actually do I think one of the questions was a non-warrantable condo. And non-warrantable condos, we can do all the way up to 75%.
Okay. Do we do commercial loans?
No, we do not.
We do not.
Okay. And what's our fee look like for foreign national, for purchase foreign national? I'm sorry, fee or rate? I think they were talking, I'm not sure if they mean fee or rate for purchase foreign national.
It's all going to be dependent on the loan to value, and so that would be on a case by case basis, and your account executive would certainly be able to work with you on that. But I will tell you that we're looking, depending on how you price it, could be in the fours up to high fives.
Okay. And how do we create an account so we can broker to you? What's our process?
So the best thing to do is to get in touch with your account executive or get in touch with Rose, and we'll certainly have an account executive reach out to you. One of the beauties about doing business with Lenture is we do not have to have you approved prior to you submitting a loan to us to look at. So you can send a loan in to us for a pre-qual. We can give you TPO access to our system. You can submit a loan to us, and we don't have to have you approved until it's time to CD that loan. So we give you the opportunity to get the ball rolling on a transaction even before you get approved. So it's a pretty easy process. We go through a company called through Comergence. It's an easy process. As a rule of thumb, it usually takes a couple, 3 days at most.
Okay. What's your average closing cost range?
Closing cost at Lenture is usually our underwriting fee is $15.95, and that's it unless there's LLC docs.
Okay. And I have a question. One entity owns about 37% of the project. I'm not sure what that means. I think might mean of the business. So if somebody's not, they own 37% of the business, would they qualify? Alex, if you can, if you want to, if I got it correct, great. If not, then go ahead and let me know.
Well,
If
it
they
kind
are
of sounds
talking,
like it might be a percentage of ownership of a number of condos, and if that's the case, we have done them. Depending, it's always going to be transaction specific. Depending what are the compensating factors. I've seen us do those, and if it's a percentage of ownership of the business, yeah, we've done those as well.
Okay. What's the rule on most non-QM loans regarding forbearance?
Tim, I'll let you handle that one.
thanks, John. So after COVID, we put some rules in place regarding forbearance. So if someone is currently in forbearance and they are refinancing their home, we're going to want to see that they have the assets to bring it current. Now, I assume, and I'll just make this commentary real quick, there's a difference between forbearance and deferment. Forbearance means that they have skipped 3 payments, let's say, and now when their 4th payment comes due, they got to pay all 4 payments. Deferment is they modified their note and moved those payments to the end. We will allow a borrower on a refinance who is in forbearance that shows that they didn't do anything crazy and they have the funds to bring it to pay that payment due at the end of the 90 days. They have the 4 months payments. We're not going to make them bring it current. Now, if it is a purchase and it's a prior mortgage and we're paying it off, the same thing applies. If it's strictly another property, let's say it's an investor and they have a couple of properties, we're going to want all the mortgages to be current at the time of closing. With a deferment, that means the note was just modified and there is no requirement there. So we don't, in essence, look at that as a negative. A lot of people entered into forbearance and deferment agreements because of COVID, and we have understood the need for that and are not penalizing borrowers for it.
Okay, great. And let's see. Alex says he's got a deal for us. Fantastic, Alex. Go ahead and reply to that email, or you can feel free to email John. And John, check your email for an email from Maureen. She just sent you one with a deal. So if you could respond to her, that would be great.
Will
And
do. Thank you, Maureen.
and can he clarify stacking? This means the borrower cost gets rolled into the loan over the life of the loan?
It's actually increasing the
I'll
loan
take this.
amount. Go ahead.
I was just going to say, basically, what stacking is, and we actually, if you reach out to your account executive or John, we have a very good slideshow. It's a pretty quick, to the point. It's not going to take a lot of your time, but it walks you through it. But basically, everyone approves loans based on LTV, and they tie the rates to the score and the LTV. So if you look at a rate sheet, it'll say 680 score at 75, for example, is a just for the sake of the conversation, is 5.75. But if you go to 80, it's 5.99, and if you go to 85, it's 6.125. So it's kind of a 680. The credit scores on the left and the LTVs on the top, and you kind of cross your fingers and come to that point. Well, what we do is we say we'll allow the borrower to stack 2%, up to 2%, on top of the LTV they qualify for. So if they qualified for 80%, and the example I'll give you is directly off of our rate sheet. So if a borrower is at 65% LTV and they've got a 740 score, our current rate's around 4.75, right? And if they were to go to the 75% bucket, they'd be at 4.875. Well, if we keep them in the lower bucket, we can just add 2% for closing costs and make it all the way up to 72% LTV. I gave you a bad example because our rate for 65 and 70 are the same. So let's just start with 70. I apologize for the confusion. If you have a borrower that's at 70% LTV, their rate would be 4.75. If they went to 75%, they'd be 4.875. We're saving that borrower that eighth of a point and allowing them to go all the way to 72% LTV. And so that 2% can be your broker's cost. So if you charge 2 points, we're just adding them on top. But it's a maximum of 2, and I think that's where some of the confusion comes in, because it's not all the closing cost as your question implied. It's literally a maximum of 2%. But if you're only charging 1.5, we have another 0.5% in there that we could actually use to buy the rate down. There's a lot of options for stacking. So I would suggest.
Yeah, if I could add to that, Tim, that 2% is 2% in LTV. It's not necessarily 2%. So, for example, at 80 LTV, at 80 LTV, we can stack 2.5 points. At 50 LTV, I can stack 4 points. So in reality, if I were doing a 50 LTV deal for you, I could stack 2 points to you, and then I could stack 2 points to Lenture and buy the rate down a full percent. So there's a lot of opportunity there if you understand how the stacking process works, and understand that it's 2% in LTV, not 2% of the loan amount. And your account executive will certainly be able to help you understand that. And to Tim's point earlier, we have a great slide deck that we can probably get out to you that would explain the whole thing in detail.
Okay,
Yeah,
great.
and it is important to just differentiate between the LTV and 2 points that you're being paid. So, and naturally, the lower the LTV, the more extra money 2% LTV gives you. So it's a great point, John.
Okay. Steven says, thank you so much for that great clarification. And final question.
I don't think that was very good.
Final question. Do you allow seller holdback?
Seller holdback for?
David, if you can clarify what you mean with that question, I will be happy to have them answer it for you. Or you can respond to the email that I'm going to send shortly, and we'll get all your questions answered. Do you guys know what that is, seller holdback?
Are you
Not
asking me?
sure what he's asking.
Yeah, me neither. Okay, with that, I want to thank everybody who joined us today. I really appreciate it. As more questions come up, I am sure they will. Please go ahead and email me directly, and we will get those answered for you. And as I said, we're going to have a account executive reach out to you, make sure that everything is clarified, and offer you that 20-minute consultation so that you can put all of the information you learned today in action. Thank you so much, everyone, for joining us today. Thank you, John and Tim, for speaking today.
Thank
everyone.
you, everybody. And I think that if you take advantage of this opportunity, you will stand out. You will be different than the rest of the people that are calling on these realtors, and you will get more business, and they will close more transactions as well. So thank you again for your time. Very much appreciated.
All right. Thanks, everyone.